Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Thursday, the 19th of December 2024. So, as usual, before we start our Daily Dose of Market Insights for today, which is very interesting, ex-post FOMC, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, we know that yesterday's key big risk event will be the FOMC meeting, which I will cover much ground later on, and as well as I'll go through the intraday technical outlook on the broad-based cross asset classes. So let us now kickstart with the FOMC meeting. So on the FOMC meeting, there is pretty much key implication going forward in terms of the movement of the broad-based cross asset classes from a medium term to long-term perspective. So as expected, the Fed cut by 25 basis point, all right, by 25 basis point. But what kind of took the market off guard, not off guard, took the market a bit by surprise is the tonality of the press conference and the dot plot. All right, so as usual, yesterday I do mention that yes, they will release the dot plot. So for those who followed my daily dose would know what is a dot plot. So dot plot is actually very quickly US Federal Reserve officials projection of key economic metrics in the US, inflation rate, growth, unemployment rate, and as well as where they view the Fed funds will be in 2025 and 2026. So that is imply how much will the Fed cut or hike next year and the year thereafter. So the key thing over here is that Fed only signal 2 cuts in 2025. Okay, previously there was 4 cuts, and interestingly, some has already factored in Trump into the forecast. So what's Trump? It's actually Trump policy that potentially could drive up higher inflation expectation, which has already been seen in the market transacted break-even rates. So what do I mean by that? So if you look at these break-even rates over here, this one, okay, so look at this 2 lines here, the dark blue line and the light blue line. So this is the 5-year US break-even inflation rate. That means this rate imply what will be the likelihood of inflation 5 years from now, which is the dark green. The light blue is inflation 10 years from now as being calculated by market transacted prices. So market transacted prices means they derive from the US Treasury TIPS inflation protection TIPS TIPS in short, which is Treasury inflation protected securities. All right, so from there we are able to infer this inflation expectation. So inflation expectation has been ticking up since September or even since the start of the interest rate cut cycle, and it's been moving up steadily once Trump has been confirmed as the US president-elect. All right, so what the Fed is concerned over here is that this 2-line inflationary expectation, 5-year and 10-year, were going to inch upwards, okay, way above their 2% long-term inflation target. So that's why I mean that they start to factor in the impact of Trump policy as being portrayed by Fed Chair Powell press conference yesterday. And also with that over here, they also what is it? Okay, they also led to what I call a change in inflation projection as well in the dot plot. So what do I mean by that? So if I were to go to the latest dot plot over here, you can actually just Google on the internet CME Federal Reserve meeting. Then you just go to the dot plot. So how do I do it? I just share with you guys. Okay, so just go to this one called Federal Reserve Government Monetary Policy / calendars. Then you go all the way down to December. Then under here, there's this projection materials. Just click on the HTML one. So you're able to see the latest dot plot or projection. So what you could see over here, right? If you could look at it over here, try to look at the median. The show median and central tendency. Median will be great, will be fine. So what you could see is they will show you the September one and the latest one. Okay, let's look at core PCE inflation. Okay, so core PCE inflation, if you look at 2025, they project it to be 2.5% year on year, annual growth 2.5%. Previously, the September was only 2.2, and even in 2026, it increased up to 2.2 from 2%. So what it means that the Fed right now has starts to deduce that Trump policy will see an uptick in inflation. All right, and US Federal Reserve Fund, where will it be in 2025? At the end is 3.9%. Previously, it was 3.4% increase as well. 2026 previously was very low at 2.9%. Now they push it back up to 3.4%. And the longer run, they expect the Fed funds rate to hover at 3%, up by 1 basis point to 2.9%. So if you look at the current Fed funds rate, which is 4.5%, minus off 3.9%, that's only imply about 2 interest rate cut next year. So overall, what we could see now is the Fed has started to pivot initially from a dovish pivot right now to a normalization pivot, and potentially they also be on hold to see latest data should they be even hiking rates next year. So implication on market, dollar strength for sure coming into the market, so that came in within our expectation. So those who actually follow our daily dose of market insights, we have been bearish on the euro, bearish on the sterling, bearish on the Aussie dollar, but the dollar yen actually did meet our expectation, because dollar yen we expect it to actually do a slight dip down, but they rally up and pierce above the 1.5, the short-term pivotal resistance data. I'll talk more about that on the dollar yen as we speak, and also Big Bank of Japan has really released their monetary policy decision. I'll cover that later on. Okay, so if we were to look at the FX market very quickly, okay, this is the 5-day rolling performance. Okay, so this should be 9th of December. Okay, so very clear dollar strength coming into the picture. And as well, this dollar strength is being supported by the push up in the yield spread between the 2-year treasury yield and the 2-year sovereign bond yield against the rest of the world. Okay, at the blue line at the bottom. Right, and the longer term treasury yield, the 10-year treasury yield, very clearly is a daily bullish breakout from the major bullish flag formation that has taken shape almost a year since October 2023 high, and also broke above the swing high of 14 November and as well as 28th of June at the 4.49%. So this implication of this bullish breakout of the US 10-year treasury yield implies that longer term interest rate will start to inch higher in 2025 as well, since this is a daily time frame chart, and the trajectory of the move going forward will be multi-week to multi-month. So what it means that you know that the US 10-year treasury yield is being used as a longer term risk-free interest rate to price corporate loans, to price housing loans. So what it means that higher cost of longer term funding is very high likelihood in 2025. That means our housing loan interest rate will tend to push up higher. Corporate loans interest rates will also tend to push up higher, given the fact that the next key major resistance level to watch out for on the US 10-year treasury yield will be at 5.2%. Okay, so that actually causes a shock, a negative shock to the US benchmark stock indices that did meet our expectation. So still recall that yesterday we do have a bullish bias on the Nasdaq 100 and the Dow Jones Industrial Average, because initially we have the view that market will still be a bit of optimism until the end of the year due to the center rally seasonality, taking into account of the other positive impact of Trump policy, which is that generous steep corporate tax cuts that could come in 2025. But market totally ignored that yesterday and concerned about the higher cost of funding that could actually trim net profit margins of US corporate earnings. Okay, so that has really been expressed. If you look at the current so-called the what is it? yeah, okay, this heat map the S&P 500 or deeply in the red, or deeply in the red. Okay, deeply in the red over here. Okay, so everything is in the red, and yesterday's for the S&P, if you look at the daily fall on the S&P here, it's pretty dramatic. So this is the cash place over. This is the cash one. So if you look at, if you measure the rate of decline yesterday, let me share with you guys something. So it's the most since I think about 3 to 5 years ago in terms of the daily fall of the S&P. Okay, let me intermediate try to actually call out. Okay, it's a bit slow. I don't know why the indicator is not showing. Okay, good. Rate of change. Okay, let me do the settings over here. Okay, just bear with me for a couple of seconds because whilst we are talking, if I have to call out new stuff from the trading view, the things tends to be a bit lag for a while. Okay. So what I'm trying to show now is the dramatic intraday fall yesterday of the S&P 500. So yesterday it dropped by, okay, look at that. So this is the fall. So it fall by negative 2.95%. All right, and this fall is the lowest since 5th of August, almost on par of 3%. That the dramatic fall yesterday. But what we could see at this point in time, if I were to look at the weekly chart of the S&P 500, okay, it seems to us that market is getting very stretched at the top as well, and potentially the next fall it could starts to actually see a at least in first step, a multi-week corrective decline to retest the 200-day moving average. Okay, which is close to this swing low here. Okay, this 5,440, 5,500 level. Okay, and also being supported by this very clear bearish divergence that is playing out on the weekly RSI. Okay, and if this weekly candle doesn't goes back up to the 50-day moving average and close at the 50-day moving average, then the higher risk that this multi-week corrective decline will start to unfold in our eyes, as the center rally seasonality got potentially cancelled out this year due to yesterday's risk event from the FOMC meeting. Okay, so this is something I want to stress that could potentially impact the US stock market. That means a lower chance of the center rally seasonality taking shape because of the negative price movement that we are seeing right now on the major US stock indices using the S&P 500 as a barometer. All right, and gold price also fell as well. Okay, so gold price also fell. So if you look at gold on the daily chart, so that also came in with our expectation. Of course, yesterday on the intraday basis, we do have a bearish bias from gold, looking for it to come down to around the 2006 level. All right, so later I'll touch more on the intraday outlook of gold. Okay, so this is the gold price. Okay, so spot gold yesterday fell by one. Okay, give me 1%, 2.3%. Okay, 2.3%. So what you're seeing in spot gold right now is also potentially inching downwards towards the this next support level at 2,485, 2,415. So this is more like a multi-week basis as well, to multi-day to multi-week basis, multi-week basis potentially giving doing that wave 4 corrective move. We in this major uptrend that is still intact since 6th of October 2023. All right, so now in the next few weeks, market will be kind of preoccupied with the push up in the US 10-year Treasury yield, impacting the longer term cost of funding because of the way the US Federal Reserve portray the latest monetary policy guidance, indicating that they're now on guard for potential inflationary pressure coming into the US economy due to Trump's incoming policy. That means, i.e., driving interest rate inflationary pressure higher due to his trade tariffs, leading to tit for tat measures from trading partners, and as well as his generous steep corporate tax cuts that will see a widening of the US budget deficits. So in the long term, if that will lead to inflationary uptick pressure as well. And what's interesting over here is that in the CME Fed Watch 2, the latest Fed Watch meeting is that almost certainty in January next year, the Fed will keep the interest rate on hold at 4.25% to 4.5%. But what's interesting is the pricing down the road, 12 months down the road. So previously, I do share with you all that the pricing, let me increase this. The pricing was market is looking at 2 interest rate cut in next year. But right now, after the latest monetary policy guidance from the Fed being from a dovish pivot now to a normalization pivot at this juncture, it has been reduced to only 1 interest rate cut next year. So what you could see over here is that the interest rate cut, potentially the highest will come in July and September next year at 96%. Sorry, will come in June, either June, July, or September at 86% for June, 96% for July, and September at 88%. Okay, the earliest for the next interest rate cut to bring it down to 4% to 4.25%. So market is less confident than the Fed to engineer 2 cuts. So they are looking at only 1 interest rate cut. And the next key thing we're going to monitor over here is that what if inflationary numbers starts to pick up next year? That means we're looking at the core PCE data, the core we call it CPI data, and most importantly, the market leading US break-even inflation rate. That means this is the rate that we are looking at to gauge a much more sensitive or reactive movement on inflation expectation coming into the US, we call it economy, will be this 10-year and 5-year break-even rate. So if these 2 lines starts to inch up higher, then this CME Fed Watch 2 interest rate expectation, this cut will be evaporated as well. That means market will start to pricing no interest rate cut next year. All right. So yeah, that is the key. We call it news flow that has taken shape yesterday. That one share with you. Okay. So now let's look at Bank of Japan. So Bank of Japan over here. So let's look at the Forex Live. This one will be the latest news. Okay. So Bank of Japan leaves interest rate. Okay. Unchanged. All right, unchanged and tremendously right, 8-1. That means 8 of them voted a no change, only 1 of them voted for a interest rate hike. So that actually sees we call it the dollar yen jumping to 155.20. So later I'll touch more about that. So it seems to us that the Bank of Japan didn't actually starts to portray a kind of a hawkish tonality yet. So they are still taking that slow time in normalizing their interest rate environment. So what we could see over here that more we call it guidance will come out from the Bank of Japan Governor Yuda press conference thereafter at the close of the Japan so-called trading hours. So that should be come around between 2 p.m. to 2:30 p.m. Singapore time. So do take a look out in the press conference thereafter to see he'll be quizzed about going forward in next year. Would there be a chance early next year? Would there be a chance of a interest rate hike and other things that he's looking out for to support the hike? So at this juncture, market seems to be picking up the bullish sentiment of the dollar as well against the Japanese yen by inching up towards the 155 psychological level. All right, so with that, let us now jump straight into the short-term intraday technical outlook. All right, the intraday technical outlook of the various broad-based cross-asset classes. Okay, without that, let me expand my screen so that you guys could have a better view of the charts over here. Okay, good. So let us kickstart with, okay, let me open up my chart. Okay, so let me close this. Yes, okay, good. Okay, good. So let's start with the euro dollar. So the euro dollar, as expected, it plunges, all right, and almost hit the support level, which is the minor swing low of 22nd of November at 1.033. And right now, what we see is extreme oversold hourly RSI that has been made yesterday, and now this extreme oversold condition is being worked out. Okay, work out over here. That means it's tends to lead to unwinding of earlier short position or short covering, I would say. So this potential short covering, as it continues to actually work out from this extreme oversold condition, may potentially lead to a intraday bounce on the euro dollar. That means what it means that after this steep fall, there could be a intraday bounce. So intraday bounce resistance level to watch will be at 1.042, maximum 1.0460. So this 1.0460 will be my short-term Titan pivotal resistance on the euro dollar. So as long as it bounces within this region over here and then surpass 1.0460, we will still maintain that intraday bearish bias on the euro dollar. So just bear in mind over here is that at this juncture, because it hit an extreme oversold position and now it's working off from this extreme oversold position by potentially some short covering that could take shape during the European session. All right, at the start of the European session. So potential bounce level to watch will be 1.042, maximum 1.0460. So as long as this bounce didn't surpass with an hourly close above 1.0460, at this level here, potentially there could be another round to inflict a bearish pressure coming back into the euro dollar again. So using 1.0460 as my short-term intraday short-term, okay, using 1.0460 as my Titan short-term pivotal resistance for today, still maintain that intraday bearish bias. A breakdown below 1.0330 exposes 1.29 figure next. Only an hourly close above 1.0460 will invalidate today's intraday bearish bias to see this intraday bounce transforming into a much more pronounced mean reversion rebound scenario, retesting the 20-day moving average at 1.0516 slash 1.0540. A breakout above it sees the retest of the previous key minor swing high of 6th of December and 29th of December, acting as a next intermediate resistance at 1.06. Okay, so that's for the euro dollar. Now, turning our attention will be the sterling dollar. So the sterling dollar plummeted as expected as well. So hitting our support level, okay, over here. So what we could see is that the next support level to watch will be at 1.2510. So as usual, but the fall of the sterling dollar is not so dramatic as the RSI is not so oversold as compared to the hourly chart on the euro dollar. But nevertheless, it's still potentially could see a bounce coming in. And do not forget, today's will have another risk event that also pertaining to the sterling dollar, which is the Bank of England monetary policy decision. Later I'll touch more about that when I cover the economic calendar towards the end of today's daily dose. So there could be still a minor bounce level to watch 1.2630, maximum 1.2675, which is the 20-day moving average, pardon me, acting as a near-term resistance level as well. So as long as this minor bounce didn't surpass 1.2675, this will be my Titan key short-term pivotal resistance for today. At this level, somewhere around this zone here, 1.2630, 1.2675, potentially there could be another round of bearish pressure coming into the sterling dollar, revisiting 1.2510 next, which is our next near-term support level. Then thereafter, a breakdown exposes 1.2460 slash 1.2450 level. So this level here, if you go back, if you go to the Fibo projection by taking into account of this current leg downwards, okay, project it to the high. Okay, that's correspond to the 1.3236%. And if you go to the daily time frame, okay, this level here is this minor swing low area of 25th of April and 9th of May this year. If you go to the daily chart, all right. So only if you see an hourly close and a breakout above 1.2675, that would invalidate today's intraday bearish bias. That means the intraday bounce has starts to lead up to a more pronounced mean reversion rebound, revisiting 1.2720. A breakout above it sees 1.2780 slash 1.2810, which correspond to the 200-day moving average and the downward sloping 50-day moving average, acting as a similar resistance level at the 1.2810 level. All right, so net overall still maintaining that intraday bearish bias on the sterling dollar, but there's still a possibility that we may shape a minor bounce scenario as BOE looms later. 1.2630, maximum 1.2675. So using 1.2675 as my short-term intraday pivotal resistance level to maintain that intraday bearish bias. Okay, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency, starting with the dollar yen. So the dollar very clearly broke above the 155 short-term pivotal resistance. So we got to respect this short push up over here. So with that, let me delete this, delete this, delete this. Okay, so the first support level to watch will be this former minor swing high of yesterday. Now turns into a pullback resistance at 154.30. So, but I don't put it so tight at 154.30. I'll use a slightly lower level, this minor congestion area here that managed to induce this long bullish Marabuzu candlestick. You could see on the chart 153.75. So this will be my short-term pivotal support level 75. Okay, let me put it in writing. 153.75 ST pivot. Okay, so this will be my short-term pivotal support level. Flip to a intraday bullish bias. Next two resistance level to watch on an intraday basis: 155.85/156, followed by 156.75/157 figure level, which is the minor swing high of 15th of November. So only a push down and an hourly close below 153.75 will invalidate today's intraday bullish bias on the dollar yen, and that would revert back the short-term bearish momentum on the dollar yen to expose the next near-term support level at 152.70, followed by 151.90, which being confluenced by the 50. These two support level is being confluenced by the there about the 20, the 50, and the 200-day moving average as well. Right, so flipping to a bullish bias using 153.75 short-term pivotal support on the dollar yen for today on the intraday basis. So now turning our attention will be the Aussie dollar. So Aussie dollar, we have been bearish since the breakdown of the key major support level at 63.60. So given the fact that it already hit our support level at 62, the third support level previously was 62.45, then below it was 62, and this 62 is also the lower boundary of this medium term descending channel that has been evolving since the high of 30th of September. So now potentially now there could be a chance that it could actually revert back up again towards at least the middle part of the channel. Okay, the middle part of this descending. Okay, that means i.e. let me put it in. What do I mean by this? That means the 50%. Yeah, over here, this dotted line here, which is the middle portion, the lower middle portion of this descending channel. All right, so with that, hourly RSI also being grossly oversold. All right, grossly oversold. So I will use 62 figure level as my short-term pivotal support for today, which is so close to the lower limit of this medium-term descending channel. We will flip to an intraday bullish bias, looking for a minor bounce to take shape. All right, so let's stress again, there's still no key signs that the Aussie dollar is shaping a major bullish formation. That means we do not see Aussie dollar right now shaping into a bullish movement from a multi-week to multi-month perspective. Why? If I were to look at the daily chart, we have been stressing for you guys, we have a daily close below 63.60. This is the major support level, and this is a major bearish breakdown of a 1 year plus of sideways range consolidation since the low of 13th of October. And with this breakdown of this major range consolidation on the downside below 63.60, the next movement on the Aussie dollar from a multi-week and a multi-month perspective is bearish, not bullish. It's only during the intraday movement there could be bounces here and there. All right, so because I want to take advantage of today's potential bounces due to the short-term technical element I share with you on the hourly chart, so I'll be using 62 figure level as my short-term pivotal support level. Potential minor bounce resistance level to watch: 62.45, 62.85, 63 figure level, maximum over here at 63.30. Okay, 63.30, 0.6330. Okay, which is close to the dotted pink line, which is the 50% median line of the descending channel. All right, but however, a price action, instead of bouncing up and immediately it just plunges again, then I got to respect the very strong impulsive down move. That means if a price breakdown below 62 figure level, then this impulsive down move will resume towards the next near term support level at 61.60, followed by 61.20 next. All right, So that's for the Aussie dollar using 62 short-term pivotal support. Flip to a intraday bullish bias for a minor bounce scenario to unfold. Minor bounce scenario, key resistance to watch 62.45, 62.85/63, maximum 63.30. Okay, so that's for the Aussie dollar. All right, so now let us now turn our focus now to the short-term intraday technical outlook on the major stock indices, starting with the Asia one, Hong Kong 33. So no change on the Hong Kong 33. We remains bearish. So the price actually gap down, hit our first support level at the 19,600 level. So no change. I don't want to put it so tight. So my resistance level here will be the gap down and the 20-day moving average. So this is my first resistance level to watch. Oops, will be at this 19,780, but still using very clearly that was rejected one time on Tuesday and rejected again yesterday, 19,960. That will still be my short-term pivotal resistance level. Still maintain that intraday bearish bias on the Hong Kong 33. Next resistance level to watch below 19,600 will be 19,337 next on the intraday basis, and below it sees the minor swing low area of 22nd of November and 26th of November at 19,030. But surprisingly, if the price action starts to do a bullish reversal due to some potential what I call rhetoric again coming out from the China top policy maker, because right now we know that the China top policy maker every now and then they start to announce something spectacularly, saying that they will try to solve the deflationary risk spiral scenario in China. It could inflict this kind of short-term covering. So a breakup above an hourly close above 19,960 will invalidate today's intraday bearish bias to expose the next near-term resistance level at 20,300/20,520 next. So now, what's next for the Nikkei 225 and the Japan 225? So it came down and hit our support level at the 39,250 level over here, and also now it actually came back and now retest this resistance level at 38,000 38,940. Yeah, this is the one, okay, which is the 50-day and the 20-day moving average. So we'll use a slightly higher level than this first resistance level for today, 39,230. This will be my short-term pivotal resistance level, which was previously the minor swing low of here and the minor swing low of 11th of December and the minor swing low of 18th of December now turns into a pullback resistance. And also if you do the Fibo retracement of yesterday push down, it also close to the 0.764 Fibo retracement ratio. So with that, as long as 39,000 tighten key short-term pivotal resistance 39,230 holds for today, we will still maintain that intraday bearish bias on the Japan 225 as it's float down towards the lower limit of that sideways range. Next near-term support level to watch, 37,990 followed by 37,700 level, and the key range support will be at 37,400. Right over here, the sideways range configuration since 27th of September this year. Right, so it's still inside this complex sideways range configuration. The key sideways range configuration support will be at 37,440. So only an hourly close and a push up above 39,230 will invalidate today's intraday bearish bias to see a push up towards the upper limit of that sideways range configuration. Near-term resistance to watch on the intraday basis will be 39,480 followed by 39,830 next. Okay, so that's for the Japan 225. Now, turning our attention will be the German 30. So the German 30 plummeted as expected, hitting our support level at the 20,000 level slash 19,960. We also close to the 20-day moving average. So with that, and also the price action now is hovering close to the minor ascending channel since the low of 19th of November. So with that, we will flip to a intraday bullish bias on the German 30 using 19,960 as my short-term pivotal support level. Near-term resistance level to watch on the intraday basis. First one level will be 20,190. Only a break above 20,190 sees 20,360 next. However, with hourly close and a breakdown below 19,960, then we got to respect the bearish price movement to see the extension of this minor corrective decline sequence on the German 30, exposing the next support level, which is confluencing with the 50-day moving average as well at 19,690/19,590 next. All right, so flipping to an intraday bullish bias on the German 30 using 19,960 as my short-term pivotal support level. Okay, now turning our attention will be the major US stock indices. So the US Wall Street 30 break below our short-term pivotal support level, and as well breaking below this, which is the 43,325, which is this this particular medium-term ascending channel support from the low of 5th of August. So with that, right now potentially is now enrolling towards the daily chart. If I go to the daily chart here, there's this dark turquoise green line. So this is the lower bound. This is the major ascending channel that is still in place since 26th of October last year. That's almost a year. So right now it's looking to actually retest this lower limit of this major ascending channel support, and as well as the 200-day moving average. Okay, so now let's go to the hourly chart for us to have a better view of the intraday move. So given that the hourly RSI is now deeply in oversold condition, so there could be some form of short covering taking shape to kind of a rework or remove this deeply oversold position on the hourly RSI. So a minor bounce scenario, resistance level to watch will be at 42,630, maximum 42,930, which is the former minor swing low of 19th of November, now turns into a pullback resistance level. All right. uh, Using this 42,930 as my short-term pivotal resistance. So as long as the minor bounce didn't surpass above 42,930, we will flip to a intraday bearish bias to respect the bearish movement of the US Wall Street 30. Next near-term support level to watch will be the major ascending channel support from the low of October 2023. I shared with you on the daily chart earlier on, 41,840 slash 41,590 next. Only a push up with an hourly close above 42,930 will invalidate today's intraday bearish bias to see the minor bounce to transform into a mean reversion rebound scenario, exposing the next near-term support on the intraday basis at 43,325 in the first step, followed by 43,720 next, which was yesterday's US session high at the start of the session, at the start of the US session. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 also plummeted below our short-term pivotal support level that we have at the 21,890 level. Instead, it plumbed straight below it and broke below the minor ascending channel support from the low of 19th of November. And right now, it's also breaking below the 20-day moving average as well, but still holding above the 50-day moving average. So with that, hourly RSI also has been in grossly oversold, so potentially right now there could be signs of short covering to kind of rework or normalize this extreme oversold condition on the hourly RSI. So potential short covering, they may see a minor bounce taking shape. So minor bounce, first resistance to watch out for will be this minor swing low here. Now turns into a pullback resistance of the low of 11th of December and 6th of December. 21,400, and if you were to do the Fibo retracement of yesterday's sell-off all the way down, the 50% will be close to the 21,600, and also the pullback line of this former minor ascending channel support now turns into a pullback resistance also at 21,600 level, and so confluence with the minor swing low of 13th of December. So using 21,600, so that will be the maximum minor bounce scenario that could unfold as this hourly oversold condition that is being worked out and induce a bit of short covering. So as long as this minor bounce didn't surpass 21,600, we will flip to a intraday bearish bias on the Nasdaq 100. Next near-term support level to watch will be at 21,780 slash 21,630, which is this congestion area here from 22nd of November all the way up to 29th of November, and as well as confluencing with the upward sloping 50-day moving average. All right, so flipping to a intraday bearish bias, but nevertheless, there could be still some form of minor bounce taking shape. Minor bounce, key short-term pivotal resistance to watch out for will be at 21,600 for today. All right, so that sum up the intraday technical outlook on the major stock indices. So now let us turn our focus now to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, price action actually plummeted, hit the 2,600 level. So that was our support level for today. And what you could see right now is that there is actually a V-shaped recovery taking shape. All right, so this V-shaped recovery taking shape, it actually takes shape close to the 76% Fibo retracement of that previous push up from 14th of November to 22nd of November, right? And also this congestion area here, 15th of November to 6th November area as well, okay, at 2,577. So as the hourly RSI hit the oversold region, extreme oversold region, and potentially now is really trying to normalize this oversold position and has yet hit the overbought level. There could be some chance of a steeper minor bounce taking shape, given the fact that it's inside this kind of complex sideways range, minor complex sideways range configuration. And what you could see over here, this could be a short covering taking shape right now. All right, over here, okay, because of this breakdown. So right now there's this kind of a failure bearish breakdown and the short covering taking shape. So this short covering taking shape that could be more pronounced on the intraday basis. I'll be using 22,577 as my short-term pivotal support level for today. I will flip to a intraday bullish bias for gold, but doesn't mean that this is a major bottoming formation and start to see fresh all-time high. No, like I said, I share you on the daily chart. Multi-week, there could still be further downside heading towards the 200-day moving average, okay, which is around that 2,400 level, 2,500, 2,400 level on the daily time frame chart, which I shared out earlier at the start of my today's daily dose. So only on the intraday basis, I flip to a bullish bias using 2,577 as my short-term pivotal support level. Intraday near-term resistance level to watch for that potential minor bounce scenario to take shape, 2,631, 2,658, which correspond to the 20-day moving average, acting as a resistance level. However, if price action starts to break down below 2,577, then I'm going to respect the impulsive down move sequence again to expose the next near-term support level. That means at 2,560, followed by the minor swing low of 14th of November at 2,537. All right, so net using 2,577 as my short-term pivotal support, flip to a intraday bullish bias for only a minor bounce rebound scenario, resistance level coming in, potentially 2,631 followed by 2,658. So that's for the Gold XAU/USD intraday technical outlook for today. Now, lastly will be the West Texas crude oil. So let me open up the chart of the West Texas crude oil for you guys to see. Okay, West Texas crude oil. Okay, this is West Texas crude oil. Okay, so the West Texas crude oil over here yesterday, it came in, hit the bounce at 70.94 exactly before trading downwards. All right, so with that, potentially now it could be starts to involve in a sideways range configuration of the West Texas crude oil for today. So what I'm going to do over here is that I will flip to a neutrality stance, since the first resistance level has been made yesterday and it starts to get rejected off this level, but still holding above the 20-day moving average. All right, so I'll flip to a neutrality stance for today. Let me change the color. So let me change the color as well. Okay, so this is not short-term pivot anymore. Okay, so oops. Okay. Okay, I can't remove the short-term pivot here, but it's hang. So bear in mind, so right now, because of the price action, it got rejected at the first resistance, and now it came down, traded, but can't actually show still showing signs of bouncing up. Can't break below the 20-day moving average, which was yesterday's short-term pivotal support level. So given that right now it may start to be trapped inside this sideways range on the intraday basis. So okay, good. So hopefully I can change this thing here. Okay, it's taking a bit of time to actually remove the short-term pivot. Okay, nevertheless, I'll just say verbally. So for today, I will flip to a neutrality stance between 70.94 and 69.30 on the West Texas crude oil. All right, finally it came out. Okay, only an hourly close below 69.30, then we could validate a bearish push down to expose the next near-term support level at 67.85, followed by 67 figure level, which is the minor swing low area of 6th of December and 18th of November. Okay, so that's also sum up the intraday technical outlook on the broad-based cross asset classes. Now, with that, let's take a look at the calendar. Like I mentioned, today will be Bank of England, and before Bank of England meeting yesterday was UK inflation. So this UK core inflation, right, it came in below expectation. So what market is expecting is 3.6% year on year. So it came in at 3.5% year on year. So you look at the trend of the core inflation over here in UK, because that will actually be one of the input to decide the decision factor of today's Bank of England meeting. Okay, so what you could see over here is that it slowly starts to linger since May. Okay, hovering at this 3.5, 3.3 level. All right, so it start to turn flattish at this juncture. So you look at the 5-year trend. Okay, it gets a bit flattish. All right, but now it starts to show signs of turning up. But one thing is that it managed to go down below expectation of 3.6%. It came at 3.5. So what market is looking at for today is that they expect BOE to remain unchanged. That means holding steadfast, right? But at 4.75%, which is still higher than the Fed funds rate by 25 basis points because they only cut two times this year. Because if you look at Big Bank of England decision, they only cut twice this year and remains less dovish by the Fed. By the less dovish by their counterparts, the eurozone. So they cut once in August, they cut another one in previously in November. So what market is actually looking at is over here is the statement coming from there. And if the statement starts to be much more less hawkish, potentially we could start to see the sterling dollar weakening after the release of that statement. So I already share with you all the daily dose of market insight, what are the key levels to watch on the sterling dollar on a intraday basis. And thereafter, today's US session will be a rather quiet one because this GDP number, right, shouldn't be we call it a market mover because this is the final Q3 number. So in the last few weeks, right, even the last few weeks, uh, second round, first round, second round of estimate has already been released by the Q3 GDP figure. So that shouldn't be a big surprise because this is the finalized figure. And going forward over here is that what could actually move the market will be this conference board leading economic index. So market is actually looking for a recovery from negative 0.4 to negative 0.1%. So that will be out at 11 p.m. Singapore time. And thereafter, do we at early tomorrow Asia session at 7:30 a.m. will be Japan inflation rate. So market is expecting the core inflation rate to tick up higher to 2.6%. So that could also potentially see a bit of movement of the dollar yen. Okay, so that will take place. The economic data released for core inflation in Japan at 7:30 a.m. Singapore time. All right, and also at 9:15 a.m. We have this China, one of the key benchmark interest rate decision, the loan prime rate, 1 year and 5-year market do not expect a cut to that. All right, so with that, that sum up today's daily dose of market insights. Pardon me, I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.